Everything you thought you understood about gold and silver was challenged today. Prices didn't slowly drift lower. They snapped, violently and without warning, wiping out hundreds of dollars in gold and double-digit percentages in silver in just a few hours. Trillions in paper value disappeared while headlines stayed quiet, leaving investors staring at their screens asking the same question: was this the top or something else entirely? Here's the uncomfortable truth. Moves like this don't come from panic alone, and they don't start where most people are looking. They are triggered by deeper forces inside the market structure itself, forces that punish emotional reactions and reward preparation. If you respond the wrong way now, you'll do exactly what the market is designed to extract. If you understand what just happened, this moment could completely change how you navigate volatility going forward. What made today's move especially dangerous wasn't just the size of the drop, it was the speed and timing. Markets didn't gradually warn participants. There was no slow bleed, no orderly pullback, no chance to emotionally adjust. Prices broke hard during a moment of peak confidence, right after new highs convinced late buyers that risk had disappeared. That's how the market inflicts the most damage. When gold falls hundreds of dollars in a single session and silver gives back weeks of gains in hours, it triggers a chain reaction. Stops fire automatically. Margin calls go out instantly. Traders who thought they had time suddenly don't. Selling accelerates not because fundamentals collapsed, but because the system forces liquidation faster than humans can react. This is how strong hands acquire assets, by letting weak hands panic themselves out. Understanding that difference is the first step to not becoming collateral in the next wave. The most important thing to understand is that this move did not begin inside the precious metals market. Gold and silver were not the source of the shock, they were the transmission mechanism. The trigger came from outside, in places most metals investors weren't watching closely enough. When stress appears elsewhere in the financial system, highly liquid assets are the first to be sold, not because they're broken, but because they can be sold fast. Gold and silver sit at the intersection of liquidity, leverage, and psychology. They are easy to trade, heavily margined, and emotionally charged. When capital needs to be raised quickly, whether due to losses in equities, derivatives, or credit, metals get sold to cover those losses. That's why these crashes feel confusing. Nothing goes wrong with metals themselves. They're simply sacrificed so pressure can be relieved somewhere else in the system. What really turns a sharp pullback into a violent crash is liquidity, or more accurately, the sudden disappearance of it. In calm markets, buyers and sellers are evenly matched. There's always someone willing to step in. But when volatility spikes, that balance breaks. Market makers widen spreads, reduce size, or step away entirely. The safety net disappears right when it's needed most. When liquidity thins, even modest selling pressure can create massive price moves. A few large sell orders hit an empty book, prices gap lower, and algorithms amplify the move. Humansis isn't driven by fear at first, it's driven by mechanics. Only after prices collapse do emotions take over. By the time retail investors react, the damage is already done. This is why today's move felt so sudden and so brutal. It wasn't chaos, it was a system behaving exactly as it's designed to under stress. Leverage is what turns ordinary market moves into financial disasters. On the way up, leverage feels invisible. Gains come faster, confidence builds, and risk seems manageable. But leverage works both ways, and when prices reverse, it doesn't ask permission. It demands cash immediately. As gold and silver started falling, leveraged positions hit maintenance thresholds. Brokers issued margin calls, and accounts that couldn't meet them were force liquidated. Those forced sales pushed prices even lower, which triggered more margin calls, creating a self-reinforcing loop. This is why prices didn't stabilize quickly. The market wasn't choosing to sell, systems were selling automatically. This dynamic explains why crashes feel unnatural. It's not a vote on value, it's a mechanical unwind. Once leverage starts collapsing, price no longer reflects fundamentals, it reflects urgency. And urgency always sells at the worst possible levels. Most investors focus on where price moves. Professionals focus on how fast it moves. Speed is the real danger signal. A slow decline allows repositioning, hedging, and rational decisions. A vertical move removes all of that. It forces action under pressure, which is when the worst decisions are made. Today's collapse happened too fast for discretion. Stops didn't protect people, they accelerated losses. By the time charts updated, positions were already underwater. That's why speed changes psychology. It creates the illusion that something catastrophic must be happening, even when nothing fundamental has changed. Fast markets punish hesitation and overconfidence equally. They reward preparation, not prediction. If you didn't already know what you would do before the drop started, the market made the decision for you. That's the lesson speed teaches every cycle. Sharp crashes at highs always feel like the end. That's because they attack confidence, not just price. When markets reverse right after a breakout, it creates doubt about the entire narrative. People start questioning whether the thesis was wrong all along. That emotional shock is powerful, but it's not evidence. True market tops usually take time. They form through distribution, slowing momentum, and repeated failures to push higher. What we saw instead was expansion followed by compression, classic volatility behavior in an ongoing trend. Violent pullbacks often happen inside bull markets, not at the end of them. The market didn't quietly roll over. It snapped. And snaps are usually about positioning and leverage, not long-term value. Confusing the two is how investors abandon winning trends too early. Moves like this don't just attack portfolios, they attack belief. The real damage isn't the red numbers on a screen, it's the internal dialogue that follows. Was I wrong? Did I miss the top? Am I about to lose everything? That mental spiral is what markets are best at exploiting. When confidence is highest, risk is most crowded. When fear peaks, opportunity quietly forms. Today's crash was perfectly timed to hit maximum optimism and flip it into doubt within hours. That's not accidental, it's structural. Markets transfer assets from emotional participants to disciplined ones by creating moments where acting feels urgent, but patience is actually the advantage. If you felt shaken today, that doesn't mean you failed. It means you were tested. What matters is whether you let that emotion rewrite your long-term plan. While most people were staring at red candles in disbelief, another group was quietly active. Strong hands don't react to headlines or single-day moves. They respond to structure. As prices collapsed, bids began to appear at key levels, not randomly, but deliberately. That's how you know this wasn't abandonment. It was transfer. Experienced capital understands that volatility creates discounts, not signals to flee. They wait for forced selling, for emotional exhaustion, for moments when liquidity dries up and price overshoots reality. That's when they step in, not because they know the exact bottom, but because they know value isn't defined by panic. This is the uncomfortable truth of markets. The same move that terrifies one group becomes an opportunity for another. The difference isn't intelligence, it's preparation and emotional control. One of the biggest mistakes investors make is assuming markets will eventually go back to normal. What today showed very clearly is that this is the new normal. Liquidity is thinner, leverage is higher, and reactions are faster than ever. That combination guarantees sharper rallies and deeper pullbacks, often without warning. As prices rise, risk builds invisibly beneath the surface. As prices fall, that risk is released all at once. This cycle isn't going away because the structure that creates it hasn't changed. Central banks, algorithmic trading, and leverage positioning have fundamentally altered how markets behave. In this environment, volatility isn't a temporary phase, it's the cost of participation. Investors who adapt their expectations and position sizing survive. Those waiting for calm conditions usually get forced out before they arrive. The difference between investors who survive moves like this and those who get wiped out isn't prediction, it's structure. Survivors don't rely on perfect timing. They rely on position sizing, patience, and predefined rules. They never put themselves in a situation where a single day can destroy them. They accept that drawdowns are part of the process, not a sign of failure. They keep dry powder instead of going all in. They understand that markets don't reward urgency, they reward discipline. Most importantly, they decide in advance how they'll react to volatility, so fear doesn't make decisions for them. Today wasn't about being right or wrong. It was about resilience. Markets will keep testing conviction. The only question is whether you're positioned to endure those tests or whether the next wave forces you out entirely. Today is already over. The crash already happened. You cannot change that. But what you do next will matter far more than what the market did today. Most people will let fear rewrite their strategy. They'll sell at the worst moment, swear they'll wait for clarity, and then miss the next move entirely. That's how wealth quietly transfers hands. Your edge isn't prediction, it's preparation. It's understanding why moves like this happen and refusing to let emotion make decisions for you. If this breakdown helped you stay calm, helped you see structure instead of chaos, then stay connected, subscribe, turn on notifications, and stay in the loop. Volatility isn't leaving. More moves like this are coming. The question is simple. Will you be reacting to them or ready for them?